All right. You know that feeling when the markets are bleeding red and every headline is screaming crisis? Yeah, for most people, that feeling is pure fear. But what if I told you that for a select few, a sea of red isn't a warning sign, it's a welcome mat? Because, you see, the greatest opportunities, they're almost always born in these moments of maximum pessimism.
I mean, we've all seen it, right? Those charts you check every day suddenly look like a waterfall of red ink. All the gains you carefully built up over months, poof, gone in a matter of days. And your gut, that natural human instinct, is just screaming at you to get out, run for the exit.
And that's exactly what most people do. It's a total stampede. They just start selling everything. The good companies, the bad ones, even the truly brilliant ones, all in this desperate scramble to just make the pain stop. That right there, that's panic selling. It's the engine that drives a market crash.
Look, in moments like these, logic just gets thrown out the window. The market isn't running on spreadsheets or earnings reports anymore. No, it's running on one thing and one thing only: raw, powerful, gut-wrenching fear. But what if you could train yourself to see it all differently?
This is where that legendary wisdom from Warren Buffett comes in. It's the absolute cornerstone of value investing. It's a call to action, really, a challenge to flip your instincts completely upside down. To see all that panic, not as a threat, but as a signal, a huge, flashing neon sign that incredible bargains might be just around the corner.
Okay, so let's really dive into that. How does all of this chaos actually create opportunity? Well, it boils down to one simple, powerful fact. When people are panicking, the market completely stops telling the difference between good companies and bad ones. Think about it. The panicked investor? They're not being surgical. They're just selling indiscriminately. They're throwing their fantastic, well-run companies out right alongside the ones that are actually struggling. And that is the key. It's the classic throwing the baby out with the bathwater scenario. Because when a great company gets sold off for no good reason, its stock price can totally disconnect from what the business is actually worth.
And this leads us to maybe the single most important concept in all of value investing. It's the one thing that acts as both your shield and your engine for profit, and it's called the margin of safety. At its core, it's a super simple idea: buying a business for less than it's actually worth.
So to really get that, we first have to talk about something called intrinsic value. Just think of it as what a business is truly worth. You know, its assets, its ability to make money, its brand, all the real stuff, completely separate from the wild up and down mood swings of the stock market.
Okay, so when a market crash happens, it can push the stock price, the market price, way down, far below that intrinsic value. And that gap between the two, that is your margin of safety. It's your cushion. It's your buffer if you get something wrong, your protection against plain old bad luck, and ultimately it's where your future profits come from.
All right, so the big question is, how do we actually find these companies with a big, juicy margin of safety? I mean, we can't just guess, right? We need a toolkit, like a professional's checklist for spotting a real bargain. So let's unpack 5 key signals you should be looking for.
First up, signal number 1 is the classic PE ratio, or price to earnings. Think of this as a quick way to see how much the market is willing to pay for a company's profits. A really low PE can be that first little hit that a stock might just be on sale. And this is a perfect example. Let's say the average company in a certain industry trades for 25 times its earnings. But then you find a solid competitor in that same industry and it's only trading at 10 times its earnings. Well, you've got to stop and ask yourself, what's going on here? That discrepancy, that could be a huge signal that you found something undervalued.
Okay, on to signal number 2, the price-to-book ratio, or P/B. What's that? Well, it basically compares the company's stock price to the value of all its physical stuff, its assets. This one is super useful for industries that own a lot of tangible things, like banks or manufacturing companies.
And here's the crucial part. If you see a PB ratio that's less than 1, that could mean you can buy the entire company on the stock market for less than what its assets are actually worth on paper. It's literally like finding a way to buy a dollar for, say, 70 or 80 cents.
But listen, just being cheap isn't enough. We also want to buy a good company. And that brings us to signal number 3, return on equity, or ROE. This number tells you how good the management team is at turning shareholder money into actual profits. It's a fantastic measure of how well the business is actually run.
As a general rule of thumb, you want to look for companies that consistently have an ROE over 15%. And here's the thing. When you find a high ROE plus a low valuation, that is a potent combination.
It's a huge clue that you might have found a fantastic business that everyone else has just temporarily forgotten about. All right, when a market goes bad, survival becomes the name of the game. And that's why signal number 4, the debt-to-equity ratio, is just so critical. A company with low debt is tough, it's resilient, it has the strength to ride out the economic storm without the looming threat of going bankrupt. And finally, we have signal number 5, strong free cash flow. You've heard the saying, profits are an opinion, but cash is a fact, right? Well, it's true. A business that consistently brings in more cold, hard cash than it spends, that's the very definition of a healthy, sustainable company. Okay, now for a really crucial word of warning. Using these signals is powerful, for sure, but not every stock that looks cheap is a good deal. Some are cheap for a very good reason. We need to talk about how to avoid something called the value trap. So, what's the difference? Well, a real opportunity is a great company that's just facing a temporary problem. A value trap, on the other hand, is a bad company that's in a permanent decline. It looks cheap, sure, but it just keeps getting cheaper and cheaper and cheaper and cheaper.
So you've got to be on the lookout for these massive red flags. Is the company's revenue falling year after year? Is its debt piling up higher and higher? Is it stuck in an industry that's slowly dying? If you see these signs, just stay away. That's not a bargain, my friend. That's a trap.
Okay, we've covered a lot. We talked about the mindset, the core ideas, the signals to look for, and the traps to avoid. So now, let's pull it all together into a simple, actionable framework you can use to start your own research. Here it is, your 5-step checklist for hunting down potential gems. Number 1, is revenue actually growing? 2, is the return on equity over 15%? 3, is the debt low? 4, is the PE ratio cheaper than its peers? And 5, does the management team own a lot of stock themselves? Do they have skin in the game? If you find a company that ticks all 5 of those boxes, well, that's a really strong candidate that deserves a much closer look.
Look, market crashes are gonna happen. They're inevitable. They aren't a bug in the system, they're a feature. And for most people, they will always be a source of fear. But now you have the framework. You have a choice. When the next storm arrives, what will you see? Will you see the panic, or will you see the opportunity hiding right inside it? That choice is yours.